Okay, on to our exercise 3 in our chapter 0, homework 1. And in this problem, we're going to look at some formulas, calculate the missing amount, and kind of practice with some of those net income, gross profit, so on and so forth concepts that we talked about in the lecture video. Okay, so as we mentioned previously on the income statement, what is included on the income statement is the revenues minus the expenses, and that calculates out net income. So our first problem here says a company has revenues of 145,000 and expenses of 92,000, and we need to calculate net income. So pretty simple math, and this will give us just a little chance to practice with some Excel and get our formulas. And I kind of want to show you how to do formulas inside of a specific cell here, because we have one space to do it, or how to kind of show things really, and even how to format some of this. So as you can see, it's already formatted as text. So that's okay. We could show our answer if we really want to show our work, which is what it asks us to do. Probably the best way to format our cell is to have it as text as opposed to a number or a counting number, etc. And so what we want to do to enter into this cell, there's two ways we can do this. We could type into our formula bar up here, but my preferred way is to select onto the cell here, double click into it, and then you can kind of see the cursor is beeping there. And so we can just type in directly. We can say 145,000. And I'll just type in revenues just to practice that. Make sure we've got this idea in our minds, minus 92,000 of expenses. And if we do the math on that, it comes out to $53,000 of net, I'll just go lowercase, net income. Okay, so that's a good way to show your work when you're doing something like this. If you really wanted to calculate this just with a number and an actual formula that did a calculation, you wouldn't want to use text necessarily. And we'll have lots of instances to practice that throughout the homework as we go. But for this problem, where it asks us to show our work, this is a good way to do it. So you can leave this here. I, as the instructor, if I look at your homework assignment, I can see that you showed your work, so on and so forth. So just kind of a nice way to do it that way. Okay, so let's go to our next problem. A retailer has sales revenue of 240,000 and cost of goods sold of 150,000. Calculate gross profit. So remember, in the last problem, we have net income, which is all revenues minus all expenses to get net income. Now, in this problem, we're really just focusing in on what kind of profit did this company realize by selling a product that, it's a retailer, so selling a product that they purchased for resale, right? Okay, so we're going to start with our 240,000 of revenues, and we're going to subtract, put the minus in there, our cost of goods sold of 150,000. And if we do the math on that, that comes out to $90,000 of gross profit. So again, a company, or if you look at that 240,000 revenues, and if you almost like equate that to, your earnings on your paycheck or something, you might be like 240,000 revenues. That's awesome, and not to say it's bad for any business or anything, but it's not the full picture, right? Because when a business is selling merchandise, or when a manufacturer is selling something that created, we're not just looking at the revenues it earned, right? In isolation. Let me type. Cogs in here. Cost of goods sold. We have to factor in the expenses associated with those, with that purchasing that product or making that product for a manufacturer, to really see how much did the business actually earn after subtracting the cost of expense to get the product in the first place. So that's the idea of gross profit. Okay, let's move on to the next problem here. The next, number 3. A retailer has beginning merchandise inventory of 32,000, purchases of 105,000, and ending merchandise inventory of 27,000. And we need to calculate cost of goods sold. So this gets back to what I mentioned in the lecture video about this kind of basic formula of beginning plus purchases, plus additions into that beginning amount to give us a full amount, the total that's available for sale. And then we kind of look and see, well, if we were to look at the end of the period and we see, a certain amount of inventory still here, in our hypothetical example where there's no stealing going on, there's no damaged inventory, there's no way that inventory could leave the factory other than being sold, then that inventory is either still here or it's been sold and it's cost of goods sold then essentially, right? So let's put that into formula speak. And so beginning inventory, 32,000. And let's just say beginning inventory. We'll just put inventory, not the whole merchandise inventory. We don't want equals. We want to add in our purchases. I do think it's worthwhile to write in purchases, just for yourself, just to try and get this locked into your mind a little bit. Like I said, this type of formula actually comes up in the first couple of chapters when we're trying to figure out some cost accounting concepts. So just the idea of beginning plus additions minus ending is gonna reappear here. So just as an overall concept, kind of getting a little comfortable with that might be good. Ending inventory. So we still have $27,000 left in our factory. And if we do all this math, that means that 110,000 was sold, and that's our COGS. That's our cost of goods sold, right? This 27,000 that's still here, that'll turn into our beginning inventory for the next period. Then we'll add more on. Then we'll sell something, right? So there's this whole ongoing cycle of business, with inventory, et cetera, where we are having cost of goods sold and the inventory is kind of cycling through. Hopefully, if you're not selling any inventory and it's just building up, that's usually not good, right? You don't want that to be the case. You do want to sell inventory if you're trying to operate a business and revenues and all that kind of stuff. So again, in earlier accounting classes, you probably talked about we talk about the accounting cycle and how it begins and starts over every month or every quarter, whatever period we're talking about. And inventory is kind of, just a component of that whole cycle, business cycle too, not just accounting cycle, but where we're constantly acquiring more inventory, selling some of it, starting the next period, month or whatever it is, next day. Starting the next period with some of that. And then, we got to buy more. There's more sales. It's just kind of cycling through, right? So that's the idea there. Okay, so let's look at number 4 to wrap this up. Using the information below, we've got sales revenue, cost of goods sold, and operating expense, and we want to calculate both gross profit and net income. So kind of combining the two things we looked at above, right? So remember that as we talked about above, revenues minus expenses equals net income. So that's what we're going to shoot for there. And then for gross profit, it's going to be revenues minus cost of goods sold. So let's do a little accounting magic here to make our life easier and not have to type this all in. If you have problems doing this, feel free to type it in, not a big deal, but I'm going to show you a way that we can kind of copy, and paste and do all that kind of efficiency in Excel that we have at our disposal. Okay, so let's, because we want revenues, and let's start with gross profit here because that's the first thing we want to calculate. Click back to this cell. We have all this, it's a text thing. And so what I want you to do is double click into this cell. Now you can see your little icon beeping there. And so use your mouse, hold the mouse key down, highlight this whole thing, and then you can right click and select copy, and then double click down into this. So you see that little cursor and paste in. And so that pastes that information in. Now that information is just a copy of this. So let's go ahead and update for the update here. So we have 210,000 revenues, and we've got 125 in cost of goods sold. And that, if we do the math there, leaves us with 85,000 of gross profit. And here's a little trick that I didn't learn for a little while until I was really working professionally in accounting and with Excel a lot. The way that, so we have this here, and that's cool. But we want to put some more information in this cell, right? And so if you in your Microsoft Word, you hit, the idea of like enter, brings you down to the next line. When you're in Excel, the way that you move down to a new line with your cursor to do more typing is you hold Alt on the keyboard, ALT. If you hold it too, it kind of does a weird thing. So don't hold it too long, but maybe it would still work if I hit enter. But hit Alt, enter, and it moves that cursor down. Just, I think maybe the best way to explain that is like when you're in Microsoft Word and you're moving to a new paragraph or a new line, click enter. It's kind of the same thing, enter again, but you have to hold Alt when your cursor is inside. And again, the cursor will show up by double clicking into the cell there. So okay, and so finally, that was gross profit. We want net income. So let's do that same little process again. We're going to double click into this cell. We're going to copy this, Control C, or you can just do it there. Then we're going to come back down to the cell we want to paste this into. Again, your cursor just goes to the end of the last words there. So again, Alt Enter. I'm going to do that twice just to kind of move it down. And then I'm going to Control V, paste that in. Again, you could right click, Control Paste. And now this is the old information we just copied. But as you can kind of see, you're able to put some text into Excel. So yeah, kind of cool way, to do things. That, again, my intention here is just to help you learn Excel along with some of these accounting concepts too. So, okay. So, net income. Yes. Gross profit. Here we go. Okay. So revenues, 210. Again, we're starting at the top. Both of them start with revenues. The gross profit is just, a step along the way, right? It only encompasses some of the expenses, just the cost of goods sold expense. But now we want to really take in all expenses. So we're going to actually, here's a little trick for us. Again, a little more Excel work. Let's copy this little component, this portion, put your cursor there, paste it in. You can make a little space to make it look good. So that's minus the COGS. Great. Another way to do, we could have started with gross profit too, but I kind of like having you play around with Excel just to get better at this. So we've got revenues minus cost of goods sold minus 58,000 of operating expenses now. And for 18 expenses, we'll just add that on. And now, this 210 minus 125 is gross profit. So we could have just said gross profit minus operating expenses. But again, just, more practice is good. And so if we were to do the math on all this, total revenues, and this is really minus total expenses because we have COGS and OPEX. So this is all the company's expenses. That would leave us with 27,000 net income. Okay. And there you go. You got a good little Excel, shows your work. If you're someone who likes to align your text in there or something, you can see it's kind of pushed up a little bit. If you wanted to get this to drop down to the bottom, as long as you have this aligned with the bottom, really what's happening is there's an extra row in here. So if you went back, put your cursor to the very end and click delete 2 times, it'll just delete those open lines in there. I do this. I'm a little bit of a stickler with my Excel formatting. So, just to show you how to play around with that. But anyway, that's some Excel work. But the big picture is understand what revenues are, COGS, gross profit, and how that interacts with other expenses to get us to a net income figure. And like I mentioned before, revenues are great. You got to have revenues. But if you were to consider revenues as the only real important metric here, you think, 210,000, wow, that's amazing. And you say you're a business owner and this is your earnings here or whatever, maybe you're a sole proprietor, one person business. If someone hears 210 in revenues, they might conflate that with like earning a salary of $210,000, right? And be like, wow, that's a lot of money. What a cool thing. Your business is doing great. And, not to say this isn't doing good or whatever, but, once you actually bring in the expenses that it costs to run this business, you realize that the actual amount that this business owner, for example, might be taking home is only $27,000. So that's a big difference if you were to conflate that with like a salary or a paycheck, kind of thing, where you're earning 27,000 versus 210,000. So there can be a very big difference. And, businesses can also have net losses too, so that can, if your COGS was too high, your OPEX, operating expenses were too high, that could even be a net loss. So very important that we have all the information. We can really make an assessment on the outcome of these formulas and whatnot. So, all right. Well, thanks everybody. That wraps up exercise number 3. I will see you in the next video for exercise number 4.